Has the economic outlook changed materially over the last few weeks throughout all this market volatility and super low bond yields?
No, it really hasn't. I mean, I think, a lot of the same fears that people were talking about, even several months ago are still being talked about today. And again, we're sympathetic to that, particularly from a manufacturing perspective. We're obviously seeing some signs of stress there. And people keep on asking us, well, look, if the next recession does come, what could it look like? And I think '01 is probably a fair way of thinking about that. The '01 recession, of course, was business-led. The consumer came through that completely unscathed. And I think that's a really important idea. Now, let me be clear. I'm not suggesting that we are going to have a recession anytime soon. It's not part of our base case, not in the immediate term. But I think if you want to understand what the next recession could look like, I think that's probably a pretty good starting point. Again, being cognizant of the idea that the consumer is in incredible shape right now. And so I think that's sort of the important framework to think about this.
Is that a lagging indicator, the consumer?
What? So the single best leading indicator is jobless claims. I mean, I know jobless claims are so unheralded, right? Like people just, they sort of, their eyes gloss over when they hear this. That is the truth.
They're solid.
It's better than anything. It does not work. I will be very, very clear on this. We've put hundreds of different variables into our model. Nothing works better than jobless claims. And jobless claims are telling you that the odds of a recession in the immediate term are actually quite low.
Lindsey, what about the outlook for earnings? Has that changed materially?
No, it hasn't. If you look out to 2020, you're still looking for 11% earnings per share growth for the S&P 500. Of course, we think that definitely has some risk in it, especially when you think about the tariffs that are going into place on the consumer good items in September and later this year. That'll definitely impact some of those sectors. But you also have to think about some of the more cyclical sectors like industrials and materials that have been dealing with some of these tariffs for over a year now. So now they're cycling that. So you actually heard industrial companies not sound as dire as you would have expected during the second quarter earnings season. So now that may all change when we get these new tariffs put in place, but and the economic environment in China continues to slow. But that is something we'll definitely be watching.
Tom, one of the things that maybe gets lost in a lot of the conversation, you say clients keep asking what kind of recession we might have, is there's a lot of room statistically between a recession, technically speaking, and like 3% growth that feels like we have great momentum. And I mean, can we stay in that middle kind of disappointing soft zone for a while?
It's a great question. Don't you feel like that's exactly what this entire recovery has been? I mean, this is the most hated economic recovery that I can remember. So, yeah, I do. I think it's easy to stay in there. I mean, look, again, I don't want to gloss over the risks. We get it. There are risks out there. But we've had a manufacturing recession, right? We had one in 2015. And again, I think we have to just be cognizant of, what are the sort of the key drivers of economic activity? And the key driver is almost always the consumer. And look, let me be clear. I've heard countless arguments for why the consumer's about to succumb, right? Like, how many times have I heard hours? Oh, well, hours slowing is the thing. I mean, really? Like, has anyone actually bothered to understand, like, hours give you nothing but head fakes over history? So, again, we're cognizant of the risk. But yes, you can continue to grow at a 2.5% pace.